10-year note yields continue to trade the range. We saw a very wide range, not this week, but the week before, setting those high yields for the year up near 3.25. Likewise, looking at the lows as the old highs at 3.12. Now this week we saw yields kind of see a consolidation inside of that range with really no threat of making a new high. And really we danced around the lows but never really pushed through. So the market had an inside week. We saw things kind of consolidate. It's almost like a spring coiling, waiting for some kind of reason for it to snap. And right now, technically speaking, I think you're looking for a breakout, whether it goes back into the old range or making new highs in yield. The market is susceptible to some kind of a break. I think equities could aid in that. You continue to see equity sell off. It could help bond buyers and see yields go lower. Likewise, if we talk about higher rates and deficit spending, then we could see yields move back to the high. So right now, we're kind of in that waiting period, that we're waiting for that what if moment that could be the catalyst for any kind of breakout. And if you look at market volatility, this is the time when I would typically expect market volatility to be higher, to be bidding. We've actually seen it do the opposite. We've seen it reverse back. We're not near the uber lows that we saw about a month and a half ago, but we are trending that way from those highs that we saw when the equity markets were dancing all around and yields were making new highs. So right now the market's just sort of taking a deep breath, taking it all in, despite the fact that the way we're looking at yields technically, it looks like we're kind of gearing up for a breakout move. Market volatility not near the red level or fear level that typically would resemble that. And lastly, let's look at some of those catalysts ahead that we have that could possibly move us around. Well, next Friday we have the advanced third quarter GDP, a big number. It's expected to be higher than we've seen over the last couple quarters, and I think that will help aid the Fed in their move towards higher rates and their move towards staying the course as far as rate hikes quarterly, 25 basis points every quarter or more. The idea here is that growth continues based off these tax cuts and based off what we're seeing out of the economy here, despite getting poor housing market news and continuing to get poor housing market news. GDP looks to be one area that is to shine. Secondly, we have the G20 meeting, which will create a lot of volatility in itself. That has to deal with a lot of trade deals with U.S. and China. Could be something where we see any kind of resolution come between the U.S. and China at that meeting at the end of October, early November. I think that's a significant what-if moment for not only the bond market, but also for equities. That is followed quickly with the midterm elections on November 6th. That doesn't necessarily have as big a market reaction instantly, but if you look after that, 2 days later we have FOMC, which we're not expecting a rate hike this November, but we are expecting some clarity for the December rate hike. Likewise, 2019 remains an enigma. I think, yes, the market's telling you that we could hit 3% effective funds rate over the long term, but the Fed wants to hit it early next year, and I think that right now the two have got to come together at least. We're going to see them converge at some point. Will the Fed come back to the market? Will the market come to the Fed? I think at this point right now is yet to be seen, and that's why we're seeing a lot of uncertainty into 2019 and may keep a cap on those 10-year note yields. This is Todd Colvin coming to you from the floor of the CME Group.